Okay, welcome everyone. Today's topic is how to get funding for your deals. This is one of my favorite topics because it's also one of the topics that many people do not understand. So I'm going to start with the basics. If you want to get funded, friends, you need to create your own corporation. So I hope that most of you have your corporation created. So let me just show you. The three types of corporations that you can create. So you have the S Corp, the C Corp, and your LLC. In a nutshell, how do you pick one versus the other one? It's very simple. So if you are going to be working by yourself in real estate, then you can create an S Corp. If you are going to be working with other people, let's say you and your partner or you and your significant other, then you create an LLC. So it's two or more people for the LLC. And the one that we do not want you to use is the C Corp because it has double taxation. So you're going to be taxed as a corporation and then as an individual. So just don't create a C Corp, either an S Corp or an LLC. That simple, friends. So once you create your LLC, then this is what's going to happen. There are four types of funding for your deal. So let's quickly go over them and explain what each of them means. So we're going to start with Harmony Lenders.
You go. We cannot hear you.
Oh, okay. Can you hear me okay? Can you hear me better? Can you hear me okay?
Yeah, I hear you.
Oh, okay, perfect. Awesome. So we'll just quickly summarize what I just said. So you have to create your corporation, or your LLC as a step number one. If you're going to be just by yourself, it's an S Corp. If you're going to be two or more people in the business, then an LLC. Make sure you do not create a C Corp because double taxation as a corporation and then as an individual. Let's talk about the four types of funding that you have for your deals. So you have the Harmony lenders, you have the private money lenders, you have the conventional lenders, and you have business credit. Let's talk about Harmony lenders. So the Harmony lenders, what I like about them is that they're asset-based. So they're going to give you the money if you have a great deal. On the other hand, they're going to charge you an arm and a leg, okay? So the interest rate is pretty high, 15, 16, 17, 18%. It's a short-term loan, 4 months to up to 1 year, and they're going to charge you points. So it varies, at least 1, 2 points is the average, but they're going to give you the money if you have a great deal. So that's the good thing about that. And not only that, but Harmony lenders, they're primarily corporations or institutions. So we partner up with Chicago Funding. Another example is Barnett Capital, Constructive Loans, Renovo. In the preferred partners tab, we have a couple of them that we work with. And then the second source of funding is private money lenders. So they are individuals like yourself, but they chose to be passive investors. So they're not going to be actively buying properties, and they're sitting on a pile of cash, okay? They're going to be charging about 2 points, and the interest rate is going to be less than the Harmony lenders. It's going to be, I would say, from 10% all the way to 14%. And again, it's a short-term loan. It may go from 3 months all the way to 6 up to a year, okay? And the difference between the Harmony lenders and the private money lenders is that the private money lenders are relationship-based, so they're individuals. So they're going to give you the money if you have two things. If you have a great deal, and then if they trust you as an investor, okay? So you have to build that relationship. In ChicagoDealVault, we have over 3,600 private money lenders. So we've identified, it's public information, people who have lent money on properties, and they put a lien on the property. So the way they work is once you have a great property, a great deal, then you reach out to the private money lenders. And then they are going to look at your deal, make sure that it makes sense, that you provide comps, and then successful exit strategies. So they're going to be looking at your numbers for a flip or for a rental. And then if they decide to move forward and give you the money, they're going to want to make sure that they insure their money. So they're going to be first position lien on your property. Okay, not only that, but they will want to be on the insurance policy as well. So in case something goes wrong with the property, it burns or something happens, then you won't get the money. They will get the money. And for whatever reason, if let's assume that you default and it's a rental, then they're going to be entitled to the rents. Okay, that's how it works. But again, it's relationship based. That is why we do the networking events, because we want to make sure that you connect with them. And what we're doing in ChicagoDealVault is we're identifying every single member if they are private money lenders. So we have identified, we have a handful of them already in ChicagoDealVault. So if you are in need of private money lender, please let us know, and then we'll make sure that we introduce you to them. But again, remember, you have to build a relationship with them. And then the third funding type is conventional lenders, okay? So the conventional lenders are like the Chase, the Bank of America, the large banks. Our preferred conventional lender is Homebridge. Now, the question is, when do we use them? We never use them on the purchase, okay? We use them on the back end. So for the purchase, we're going to be using the hard money lender or the private money lender. So they're going to be asset-based. Why are we not using the conventional lenders? Because they are not asset-based. So they're going to be focusing their decision on your income tax, your W-2, and they want to make sure that the property is in livable condition. So the properties we're going to be targeting are distressed. They might not be in livable condition. They might be missing appliances. The utilities might be off, right? If it's an REO, we might not be able to get the water on for the inspection. So conventional lenders are not going to lend the money on those type of properties. However, we're going to be using the conventional lenders to refinance. So once we use the asset-based lenders, and then we rehab the property, we rent the property, then we're going to get the conventional lender to pay off the high interest rate, short-term hard money lender or private money lender. And then through the conventional lenders, we're going to be able to get a longer-term loan with the lowest or lower interest rate. So that's the beauty of it. And not only that, but we might be able to get money out when we refinance, just to make sure that we have very little money on the property. But overall, friends, the reason why you want to use a hard money lender and a private money lender on the purchase is because you want to focus on using other people's money. In this case, we want to leverage from hard money lenders and private money lenders money, right? So that you have as little money as possible in the deal. Now, the question is why? Well, number one is because that's going to help you grow. Because imagine if you have $50,000 and you put it all into one deal, guess what? All your money is stuck in one property and you're not going to be able to grow. Therefore, you've got to use other people's money and as little money as possible from your pocket so that you can grow and do as many deals as possible. Now, let's talk about the fourth funding type. And many people disregard this funding type, and this is called business credit. Business credit is credit on your business. So what does that mean? So when you create your S Corp or your LLC, then you can apply for business credit. So like a credit card, but it's going to be linked to your corporation or to your LLC. It's not going to be on your personal credit. It's not going to be for your personal usage. Is going to be for the corporation, okay? And there are companies that's all they do. You can hire them and they can apply for business credit on your behalf. And what I don't like about them is that they charge an arm and a leg. So they charge about 10%, from 8 to 12% on the credit they're able to get you. So in our case, I didn't know any better about a year and a half ago. So I hired this company, and they were able to get us 40,000 in business credit. So they got us like maybe 4 or 5 business cards, amounting to a total credit of 40,000. So they charge us 10% of that. So it was 4,000 we had to pay to this company. And then I just found out that they were just regular business cards, right, from big banks. So I was so disappointed, so upset, because how come I paid 4,000 just to have them fill out an application, or 4 or 5 applications? To me, yeah, that just didn't make sense, but I didn't know any better. So what I'm gonna do for you guys is please make sure that you come on Saturday, because I'm gonna have a hard copy of all the credit cards that we have, business credit cards that we have. So I'm gonna give you their phone number and website, so you can avoid paying all these companies, third-party companies, to apply for credit on your behalf. You can do that yourself. It is so simple. So we're gonna give you the phone numbers and the websites of those companies. Not only that, but on the cards that we have, I'm gonna put the available balance that we have, so you get an idea what banks are gonna give you the most, okay? And what's really amazing, friends, is that this is what I love the most about business credit. That I didn't have a W-2. I mean, because I didn't have a full-time job, right? So I haven't had a full-time job or a W-2 since the last 3 years. But they don't focus on your W-2s or income tax. That's what I love about it. You're going to be the guarantor, okay, on the credit cards. And the better your FICO score or your credit, the more money they're going to give you, okay? So what's so awesome about this is that, once I got the 40,000 in credit, then I called the company and I said, you know what, we're working on a project. And then at the time was ChicagoDealVault, right? So I needed more funding for the development of the software. So I said, can you increase my credit line by 20,000? So they put me on hold for about 5-10 minutes. And then they came back and say, what's the reason for the increase? I said, business growth. We are growing. And then they're going to ask you, well, what's the expectation for your revenue, your sales? I said, we're doing amazing. And they said, okay, so hold a second, please. And then they came back to me like a few minutes later, and they said, well, you've been approved. And boom, they gave me like 20 more thousand, right? So about a month ago, right? So I had 70,000 on a business credit card, okay? And then I called them, and then I said, can you please increase my credit limit? And they said, sure, Mr. Galicia, what increase would you be looking at? I said, please increase it from 70,000 to 150,000. And they said, what's the reason for the increase? I said, business growth. We're doing great. And then they said, okay, so please hold a second. So they made me wait about 10-15 minutes this time, right? And they came back to me and they said, Mr. Galicia, we've been able to increase your credit line to 120,000. Is that okay? I was like, oh, just 120,000? Yeah, that's great. No, that's not a problem. So I was obviously happy about the increase, and I just couldn't believe that, right? No documentation required, no nothing. And they just increased our credit line. And not only that, but then you also have cash advances on that credit line. So let me just show you that on the screen. So this is a credit card, okay? That's our latest bank account statement. So the credit limit is 120,000, right? The cash credit line is 24,000. So what does that mean? What that means is that you can go to the bank, like let's say tomorrow, and then get the cash, the 24,000, okay? That's simple. So do you see the power of that, friends? So how the question is, how do we use this money? Very simple. Because when you are going to purchase a property, And then you're going to be using, as I told you, asset-based lending. Harmony lender or private money lender, guess what? They want you to have skin in the game. So they're going to finance, I would say, up to 90% of the purchase price. And then they're going to finance about 100% of the rehab. So the way we've done it in the past is, let's say the property is going to cost 100,000, right? So the Harmony lender is going to finance 90,000. Okay, so we need to come up with $10,000 out of our pocket, right? Because they want you to have skin in the game. Guess where that money came from? Cash advance from business credit. So we went to the bank, we took the cash advance, and boom, that was our down payment for the purchase. And then the Harmony lender gave us the money for the rehab. But guess what, friends? They're not just going to give you the money. Let's say we bought it for 100, and then the rehab is going to be 20,000. Let's assume they're not going to give you the 20,000 for you to do the rehab. The way they do it is they are going to ask you for the scope of work, for the rehab estimate, and then let's say you say, well, it's going to be 20,000. So then you have to fund the rehab. Once you do the rehab, the bank is going to come and do an inspection on the property. And if they see that you've done everything that is on the scope of work, then they're going to release the 20,000. So guess what we used to fund the rehab? Business credit, friends. So at this point, zero money has come out of our pocket. Does that make sense? We're leveraging from business credit. So we're using our business credit cards to pay for materials and labor, which is temporarily, right? So we're going to fund the rehab through business credit. And then once the work has been completed, we're going to make a phone call to the Harmony lender or private money lender and say, listen, we've done the work. Can you come inspect the work? So they come. And they say, well, yeah, it looks great. And they're going to release the funds. So the funds go into your checking account. And then we use those funds to pay back the credit card. Does that make sense? So we're just using all other people's money, OPM, right? So we're at this point putting zero money out of our pocket. Does that make sense? I mean, this is just so powerful, friends. So the Harmony lender or private money lender are going to finance the purchase price, and the business credit is going to fund the down payment. And then we're going to use again the business credit cards to fund the rehab, labor, and material. And then we're going to bring the conventional lender. So once the property is finished and then we rented the property, then all in is, let's say, 120,000. Okay, and then the property is worth about, let's say, 200,000. So the conventional lender will refinance the Harmony lender. So they're going to pay off the Harmony lender. So they're going to pay off 120,000, and they will allow you to do cash out, but you have to have 25% equity on the property. So if the after repair value of the property is 200,000, you can pay off the outstanding loan, which is 120, 100 for the purchase, plus the rehab, 20, so 120 all in. And then you can cash out up to 30,000. And that's how you're going to be able to use other people's money and grow and have zero money on the deal. Not only will you have zero money on the deal, but you're going to be able to get cash out up to 75% of the value of the property, because the bank, the conventional lender, wants you to have at least 20 to 25% equity on the deal. So as you can see, the key point is for you to find a great deal with tons of equity. So now, talking about a great deal, let me show you an example, a real life example. So this is a property in Evergreen Park, 3-bedroom, 1.5 bath, about 1,000 square feet. So as you can see, two things to keep in mind. The purchase price that you guys have to focus on is less than 150,000. The second thing to note is that we focus on bread and butter area. So Evergreen Park is a bread and butter area. So it's a B minus C plus area. Okay, so we don't focus on, or we don't purchase on A areas, like the expensive areas, right? Glencoe, Wilmette, and so forth. Or we stay away from the D areas, the very dangerous areas. So bread and butter, less than 150,000 purchase price, and also less than 1,500 square feet. Friends, why is that so critical? Because there might be properties under 150,000 that have over 2,000 square feet. So why do we try to avoid those properties? Because the bigger the property, guess what happens to the rehab? The rehab is going to be very expensive. So the way we typically do it is we multiply the square footage times 2 to get the rehab amount. So here we would, without looking at the property from the inside, assuming it just needs a light to medium rehab, then the rehab on this property will be at least 25,000, okay? But if the property, once we inspect it from the inside, requires more work. What's more work? More work is, for instance, when you have to do the roof, when you have to replace all the windows, when you have to, let's say, rewire all the electric system, when you have to redo some of the plumbing system, when you have to touch foundation issues. That's sort of like major works. That's not considered light to medium. So then you have to keep that into account. So in this case, the rehab for this property was not light to medium, right? We had to do a lot more to the property. That is why the original estimate of 25,000 when we used the square footage did not work. We had to do windows and roof. That is why the rehab was a little bit higher. But this is the key, friends. All in, as you can see, is 137, but the ARV, that's what's truly important, friends. The ARV on the property after repair value is 220. So let's run through the numbers right now. So for the purchase price, 92. So you're gonna need to come up with 10% of that when you purchase the property. And then guess where that money is gonna come from? Business credit, cash advance. So 9,000, boom, down payment. And then the Harmony lender is gonna put the other 90%. And then for the rehab, again, you can use the business credit to pay for labor and material. And then once you've done all the rehab, guess what? The Harmony lender or private money lender will inspect the property, make sure that everything is done properly, and then they will pay you back the 45,000, which in turn you pay back the credit card. So all in is 137. But at this point, how much money do you have stuck in the property? So far, you've been reimbursed 45,000. So the only thing that you have in the property is the 10% down payment that you took from the business credit card. Okay, so about 10,000, right? Plus the closing costs, so maybe 12,000 or so, 12, 13,000 stuck in the property. Okay, so the next step is once you've done the work, and then the appraisal came back at 220, then you have to rent the property, okay? And then, since we're using the Harmony lenders and private money lenders, they charge very high interest rate, and they are short-term loans. Therefore, you have to refinance the property to pay them off. So that's when we're gonna be using the conventional lender. Our preferred conventional lender is Homebridge. So this is what happens when you refinance. So as I told you before, you can use up to 75% of the value of the property to pay off the Harmony lender and cash out. In this case, we did just a refinance. So all in was 137. So we wanted to pay that off. Okay, so we used the conventional lender and took out 63% of the ARV, which happens to be 140,000. So what's the result of this? When you refinance, then you have a longer term loan, a 30-year loan at a much lower interest rate, like 5.5, versus 12 to 16% interest rate short term, right? So you're gonna be now paying a lot less on your principal interest monthly, or your debt service. So this is what the numbers look like when you do the rental. But before we look into that, at this point, you're gonna have equity of about 36% or $80,000. You see the power of these, friends? So you have about 13,000 stuck into the property when you purchase a property, but after you refinance, guess what? You're gonna get that money back. So you have zero money on the property. Not only do you have zero money on the property stock, but you have equity of about 80,000. So this is how you're gonna be able to increase your net worth. So imagine if you do 10 deals of these, you're gonna increase your net worth by 800,000. Does that make sense, friends? So this is how the numbers look when you rent a property. So the rent is $1,700, and then the principal, interest, tax, and insurance after we've done the refinance is $1,150. Therefore, the positive cash flow on this deal is $550. So you have two options. Either you spend that cash or you apply that towards the principal to pay down the loan. That's the power of real estate and wealth. When you start paying down the principal on your conventional loan, because guess what? Instead of paying interest to the bank for 30 years, you're going to be able to pay off the property in 10 years or less. That's where true wealth comes from real estate, when you have paid off properties. Because guess what? Then not only will you have tons of equity, but your cash flow is going to increase tremendously, because all you need is to pretty much pay for maintenance, for the upkeep of the property, the taxes, and the interest. So your cash flow is going to be phenomenal on the properties once they're paid off. So this is the secret sauce, friends. Something that you have to understand when it comes to financing is one ratio. It's called the debt coverage ratio. Okay, so what does that mean? This ratio is used by all lenders. So they want to make sure that the property generates enough income to pay all its operating expenses, such as maintenance, taxes, insurance, and most importantly, the debt service, right? The principal and interest. And then you have 25% left over. So let me give an example. If the rent is $2,000, then the bank is expecting that when you pay the principal, interest, tax, insurance, utilities, maintenance, then all of that will be only $1,500, and you're gonna have in your pocket $500. Okay, so they want to make sure that you have an overage, or you have excess cash of 25% of your total income on the property. So again, if the rent is $2,000, so they want you to pay about $1,000, let's say, in on the debt service or the mortgage, the principal and interest, and then $500 for operating expenses. So utilities, but utilities are mostly paid for by the tenants, but the maintenance, taxes, and insurance. So they need to amount to no more than $500, so that you have 25% of the rental income. So 25% of 2,000 is 500. So they want to make sure that you're cashing out at least 500 a month positive, so that they lend you money. So let me give you the example with the numbers right here. So the debt coverage ratio measures the ability to pay the mortgage, okay? Not only the mortgage, but also your operating expenses, right? Like the taxes and insurance. So the way we compute that is the net operating income, and to compute the net operating income is your income, which is the rent, minus your operating expenses. What are your expenses when you own a rental? Utilities, which hopefully the tenant pays for them, then the maintenance for the upkeep of the property, your taxes, your insurance. And if it's a townhome or condo, then you also have to pay the association or HOA, homeowners association. So whatever is left, that's your net income. So you divide that by your debt service, which is your principal and interest, so your mortgage payment. And then if the ratio is 1.25 or above, then you're going to get funded for the deal. What's really cool, friends, is that you don't need to worry about all these computation because in ChicagoDealVault, we give it to you. I just want to make you aware of what the formula means and that you understand what this ratio is for. So an example of a debt coverage ratio of 1.33 means that the property will generate 33% more cash than what it's required to pay the mortgage payments. It is that simple, friends. So let me show you an example in ChicagoDealVault. So let's log on to, and then I'm gonna find a great deal for pre-foreclosures, okay? So we're gonna select, let's say Bergwijn. And then remember, we are going to filter by high equity. So we just want the awesome deal. So people who owe very little to the bank, but their property is worth quite a lot. So we found 26 awesome deals. Just randomly pick one of them. Okay, so this property, we're gonna give you the debt coverage ratio in the rental calculator. But let's just quickly look at the numbers. So this is a 3-bedroom, 1-bath, 1,400 square footage. So what's really critical about this is, first of all, how much is owed to the bank? 98,000. And then, are there any other liens? Yes, there's another lien from Citibank for 3,000. Okay, so about 100,000 plus fees and penalties. Add another 10%, so about 110,000. But how much is this property worth? Look at this. So this property is worth over 220,000. Therefore, there's an estimated equity of over 100,000. So this is obviously a great deal. And then based on the square footage, we're gonna give you an estimated rehab, light to medium range, with the assumption that it's in a BC area. And again, it's a light to medium rehab. But obviously, you always have to see the property from the inside. And then finally, we're going to tell you how much you need to make an offer for depending on your strategy, okay? So in this case, you have plenty of room for this property. Now, if you click on the rental calculator, this is where we're going to tell you the debt coverage ratio. So the debt coverage ratio is way over right now 265. But guess what? We have not entered any of the operating expenses. So we know what the income is. Now, to get this, as you can see, is based on the net operating income divided by the mortgage payment. But we have to put in the expenses. So the utilities ideally are going to be paid by the tenant. So I'm going to leave this as 0. And then the maintenance, the upkeep. So we're going to put at least 80 a month. Then the management fee, 50. Insurance is going to be, for this type of property, is going to be about 90. And then the taxes. So for the taxes, what I will do is I'm going to click on owner loans. That's where we pull the public records from. This is going to give you the transaction history, mortgage history, and most importantly, taxes. for any off-market property. So at this point, I will scroll down and then look up the taxes. So the taxes on this property are $5,300. So I'm gonna divide 53 by 12, okay, to get the monthly expense for the taxes. So it's gonna be about $440. So if I go back up to the mortgage calculator, I'm gonna put in $440 for the taxes, $440 for the taxes. Now, how much are we gonna pay for the property? So based on this, if we do a flip, let's do a rental on these, we can pay up to $157,000. So let's assume we paid $157,000, and the rehab, I'm gonna go on the high end. So the rehab is going to be $35,000. Okay, because I just want to be conservative on this property. 3,500, 35,000. 1, 2, 3. Okay, so let's calculate. And in here, look at the debt coverage ratio. So the debt coverage ratio is 1.77, and you're going to be cash flowing 529. So as you can see, lenders are going to be looking at a debt coverage ratio of 1.25 and above. In this case, as you can see, the net operating income is $12.15. That is computed by taking the income minus all the operating expenses, minus all of these expenses. Okay, that's how you get the net operating income divided by the mortgage payment. And in this case, we got a higher number, which is great. That means that your income is a lot higher than what you need to pay on a monthly basis for your mortgage payment. So this is what we want, friends. We want this to be higher than 125. But we're going to compute all the numbers. You just need to check right here. Once you put all the numbers, that is going to be higher than 125. So friends, it is that simple. Let's quickly summarize what we've done today. We talked about you setting up your entity, your corporation or your LLC. So what I suggest is, if you're an individual, just yourself, do an S Corp. Stay away from C Corp, because C Corp double taxes you on the corporation side and then on the personal taxes. And then if you're going to be working with a partner, your significant other, then you create an LLC. Once you have all that set up, make sure you apply for business credit. And then on Saturday, when you come, I'm going to have the hard copy, because you are members of DealVault. I'm going to give you the hard copy of the numbers and websites that you need to call to apply for business credit, because you're going to be able to leverage other people's money. You're going to be able to use this credit, business credit, to fund not only the down payment, but also the rehab before you get reimbursed by the hard money lender or private money lender. And then once you've done the rehab on the property, you're going to be using the conventional lender to refinance, to get your money out and potentially cash out if you need to for the next deal. That's how you're going to be able to grow quickly. That's how you're going to be able to do many, many deals. And finally, we talked about the debt coverage ratio. So the debt coverage ratio is used only by lenders. So they want to make sure that when they take your income minus your operating expenses, utilities, taxes, insurance, association, that what's left is going to be enough to pay the bank, to pay the mortgage payment. And not only that is enough to pay the mortgage payment, but that you're going to have excess cash of 25%. So in other words, if the rent is $2,000, they want you to make sure that all your expenses, including the mortgage, are not to exceed $1,500. So they want to make sure that you have a positive cash flow of $500. So when you look at a property, friends, just quickly run the numbers on the rental calculator, just to make sure that once you pay the mortgage, all the operating expenses, you still have 25% in your pocket of that rent. So if you collect, let's say, $1,000 for rent, okay, you need to have in your pocket 2,500. Sorry, 250. And the rest goes to the mortgage, payment, utilities, hopefully are paid by the tenant, taxes, insurance, and maintenance, okay? Another amount that does not exceed 750 so that you get to have 25% in your pocket of positive cash flow. That concludes tonight's seminar, friends. So are there any questions on the line? I just focus primarily on funding, the type of fundings that you have available. And make sure that you leverage from our preferred partners, right? So in here, you're gonna find conventional lenders. So you're gonna find Harmony lenders right here, boom. Then you're gonna find conventional lenders in here. Home inspector, where is my conventional lenders category? Can anybody see that? Can anybody see that? Oh, lender right here. Boom. Homebridge. So that is conventional lender. Okay, so these are your, and then on Saturday, I'm going to give you a hard copy of the websites and phone numbers you need to call to start building your business credit. So we have 6 or 7 business credit cards. So I'm gonna give all that information to you so that you can leverage from other people's money. That is the key, friends, to make sure that you grow quickly. Use other people's money, use business credit, use on the purchase price, Harmony lenders, private money lenders, and on the back end, conventional lenders, so that you refinance, pay off the expensive guys, and if you want, you can cash out so that you can use that money for the next deal, or just leave it as equity in the property, and then you move on to the next deal. Are there any questions on the line, friends? Any questions on the line?
Thanks, Hugo.
Okay, so if there are no questions on the line, friends, I look forward to seeing you on Friday at Flick Park in Glenview, or Saturday for sure at 1 p.m. at the DoubleTree in Oak Brook.
I have one question.
Okay, friends, so thank you very much for joining tonight's webinar, and then I look forward to seeing you in person on Friday or Saturday.
Hugo,
Thank you very much. Yes, go ahead.
Will you be sending a replay of this? Because I joined in late.
Yeah, that's not a problem. As usual, we're going to send the replay by email, and then under the training tab, it's going to show tomorrow morning. So here we have the training tab. We're posting all the masterminds. So if you happen to miss a mastermind, it's going to be right here.
Oh, okay.
So go to the training tab and then just scroll down, and it'll be here and it'll be in your inbox. I want to make sure that you go over these as many times as you need to, because this is the critical piece of growing your real estate business, using other people's money. So I just gave you the secrets. And on Saturday, I'm going to give you who you need to call to apply for business credit, so that you use that money on the purchase side for the down payment and on the rehab temporarily while you get reimbursed by the Harmony lender. So it is so powerful, friends. I'm just giving you the secrets of what we've done to be able to grow and do 23 deals in the last 2.5 years. Okay, so thank you everyone for joining, and I look forward to seeing you Friday, 5 to 8 p.m. at my daughter's birthday party, or Saturday, 1 p.m. Okay, we're gonna show you how you can increase your net worth by 1 million in the next 2 years. Thank you everyone for joining tonight.